Welcome back. You're still watching Samvat Market Masters, and with me is Shankar Sharma of First Global. So, what is your basis of this 10% growth that you see from now over the next 1 year in the markets? Because if there's no leadership from technology, there's no leadership from banks. Where do you see leadership emerge from?
I think the leadership will emerge from. I mean, there are two things here. One is the autos look good. I think they're still very, very strong, and they will keep rallying higher, in my view. Second, the 10% or more could simply come on account of lower rates and lower bond yields.
Okay.
So don't forget that markets are a function of growth and the cost of capital. So you may not have great growth, but the cost of capital declines, then the same growth looks more attractive. So you are already at 7% or 6.7% bond yield. In my view, they can go a lot lower.
Okay.
That itself will propel your markets higher. Okay. In fact, the very fact that markets are up 10% in the last 12 months without any earnings growth tells you that there has to be something else driving it, right?
Yeah.
And that something else are lower bond yields, which were 8%. Now they are 6.7%. They could easily be down another percent or so.
Okay.
That's what is going to drive the market.
And sectorally, apart from autos, anything else that catches your eye?
In large caps, that's what I like. Cement looks good. I mean, that's been a favorite for a long time.
Okay.
So autos and cement look good. Other than that, I mean, they're very tepid, very, very tepid.
We'll talk about the smaller stocks in a bit, but before that, wanted your thoughts on this whole emerging market play, this debate about India versus China. Most people tell us that China is looking a lot more attractive now. What would your view be?
I would tend to agree. I think China has lost a lot in the last 12 months' time. I think it's bottomed out. The other thing in China you must remember is that the property market is in a completely stratospheric zone. It's huge. It's almost like what the stock market was 12 months back. It's like a runaway bull market. Now they will try to cool down the property market. They already are. When they do that, that money will flow into the Chinese stock market because it's ultimately a seesaw between property and stocks. So that will provide, I think, a good upward momentum for the Chinese stock market because the property market there has just gone ballistic.
So it's not that India's share will move to China.
Look, I mean, if we look at the India weighting in the MSCI India is about 8% or so. China is about 25%. So there's just no comparison. We should not worry about our weighting moving to China and all that. I mean, our near competitors are more like Brazil and all that. China is like three times our size.
Okay.
Yeah.
So, coming back to that argument about the market up move, what do you see as the trend, say, over the next 3 to 6 months? Are we staring at some sort of consolidation in the market before an uptrend resumes itself? Because we do have many global and local triggers upon us, and they're not looking that good at this point.
They're looking terrible. So as I said, the only thing that I believe will propel our markets higher, or let's say two things. One is the big global sort of move towards emerging markets. Remember, emerging markets went through a tough time between 2010 and 15. It was a shunned asset class. When something is that beaten down, it comes back, and it has started coming back from this year. And this year, EMs in dollar terms, if you look at the aggregate, they've done quite well. I think about 30–40% up. So I think that momentum is enough to propel India as a part of a emerging market basket. And the second factor will be bond yields. I am not optimistic on earnings growth coming back and driving markets up.
Okay. How long do you think we'll have to wait before we get back to, the 10–15% earnings growth?
Now you're talking, I think everybody pencils in 17 to 20%.
Yeah, that's for FY18. I think a lot of people have even written off FY17.
Look, that was not in the beginning of the year, right?
Yes.
So each year everybody starts with 17, 18%, and by the time the year comes to a close, I think you're at 0 or 5%.
Yeah.
That's been the range last 3 years. I don't think that's going to change. And looking at the IT picture, looking at the pharma picture, I don't see how large caps, because they dominate the earnings pie chart. Small caps can do well, but I mean, they are not going to dominate the earnings pie chart, right? The pie chart is still large companies. I don't see where you're going to see, double-digit growths.
Okay, since you believe that large caps may not offer so much value, let's talk about the mid and small caps. Any specific sectors where you are seeing value now?
I mean, a lot of them have depressed earnings, so value depends on how you project out the earnings. For a number of sectors in the commodity space, in the chemical space, in infra space, I think because of depressed earnings, the valuations don't look cheap. But I think if you project it out 12 months or 18 months or 24 months, they will look very, very cheap. And those are the areas where I am particularly focused on.
Okay.
So those spaces still look terrific.
Okay, so within infrastructure, what are you looking at? Like some of the road builders?
Again, there you go. We can't talk stocks, unfortunately, but I think infra is a good space. Yeah, road builders are good too.
Okay. Since it's Diwali, I mean, you can give us a couple of stock ideas. Come on, you've been investing in names like A to Z, Kiri Industries. You've made money in some of them as well. For the retail investor watching you now, what would your advice be this Diwali?
I think the advice is very simple. Buy these sectors. I can say chemicals still look very, very good. My view is, without going into any particular stock, my view is that it's going to be, a pretty long journey for chemicals.
Okay.
I like that. And within that, there are many good companies, and it's not very difficult to find a few names in there. And I like infra, in particular infra where you can see balance sheet stress being addressed. There are a few out there. So I mean, these two broad sectors have worked very well in the last couple of years. I think they'll continue to work very well in the future too.
But when you talk about balance sheet stress, are you talking about the ones that are seeing some amount of relief, like sort of the JPs of the world, the IVRCLs, or are you looking?
I don't think. I mean, they're not on my buy list. Okay. I think their stresses are a little bit more
deeper
than what I'm prepared to stomach.
Okay.
There are ones with a lot less stress.
Okay.
And I think those names are out there.
And you spoke about commodities as well. Within commodities, what are you looking at?
Steel looks good. I like steel.
Okay.
Steel is good. I think overall commodities look good. So chemicals also in that sense, is a commodity, right? I think the whole cycle for all these sectors bottomed out, in the last few months' time. I think they're all looking good.
Okay, so before we wrap up then, what would your advice be to retail investors out there? Is this, because there are some thoughts that, post the US elections, whichever way it heads, there could be a big bear market coming globally, which could take our markets down as well. You don't believe that theory?
Maybe it does, but what I'm saying is the stocks and the sectors that I'm focused on are not very sensitive to those kind of news flows. And I've seen a lot of turmoil in the last 6-8 months, but some of these names, they don't suffer much even in sort of downturns. So that's my exact point, that these companies are not going to be dancing to the tunes of global macro or US elections or US Fed. They are dancing to the tunes of their own individual industries. I think you're better off focusing on those because the globe doesn't look settled. Nothing looks settled in the world.
Okay.
So, that's why
India will outperform most of the developed markets.
Oh yeah, for sure.
Okay, on that optimistic note, Shankar Sharma, thank you so much for joining us.
Thank you.